Welcome to the Lend Academy podcast, episode number 220. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's episode is sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech. Lending and banking connected. Go to lendit.com/USA to register. Today on the show, I am delighted to welcome Luz Urrutia. She is the CEO of Opportunity Fund, and a position she has held for about a couple of years now. I wanted to get Luz on the show because I've always been fascinated, or for several years now, with Opportunity Fund. They are the largest non-profit small business lender, micro lender in the country, and I feel like they have just such an interesting story where they're loaning money to people who are underserved at very reasonable rates and have very reasonable default rates. So wanted to sort of dig into that and find out why. And Luz is actually very generous in sharing a lot of the insights that has really enabled her company to be successful. And so we talk about the underwriting, we talk about how they sort of are more than just a lender to these people. They really are a part of their borrowers' lives. We talk about how they've sort of managed their relationship with Lending Club. That's a big part of what they do, and where their capital comes from and what's next for 2020. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Luz.
Thank you, Peter. Glad to be here.
Okay, so I'd like to get these things started by giving the listeners a little bit of background about yourself. And you've had quite a storied career, I would say, so far with working in the banking system. So tell us some of the highlights of your career today before Opportunity Fund.
Sure. So I'm originally from Venezuela, so I'm an immigrant myself. I've been here for a very, very long time, came to this country to learn English and finish my undergraduate, and then started working for a bank. At the time was Wachovia Bank. Then went and got my MBA, and then I got this little bug in me, driven mostly by my original experience when I started working at Wachovia, that I was turned down. I applied for a credit card, and they turned me down because I didn't have any credit. And so I thought that was pretty odd because I could be working for a financial institution, but they wouldn't give me credit. And I promised that one day in the future, I would go build a bank or a financial services organization to serve the underbanked population with responsible and affordable financial services for people that didn't have access. Mm-hmm. And so that sort of drove my, pursuit of working in a number of different organizations to develop knowledge and understanding about this community. So from that, I built the bank, ran it for about 13 years, sold it. Then I came to California, started working for a company called Today Oportun. It was Progreso Financiero. And, they also worked with small dollar, primarily at the time, immigrants, Hispanic immigrants that didn't have credit or had thin files. And then, I decided that I needed to think about, I've been in the for-profit world my whole life, and sort of balancing profits with mission is a real difficult tension at times. And so that kind of brought me to coming and joining Opportunity Fund, A, because I was passionate about their mission, and two, because I felt that how about if I start with a mission and allow the mission to drive the sustainability of the business. Mm-hmm. So really my whole entire career has been focused on financial services, and the last 17 pretty much serving underserved populations.
Right. Interesting. So, obviously Opportune, had Raul on the show before, and they certainly are focused on an underserved population. And so I'm curious about the crossover between the population, but actually let's just hold that thought, because maybe we should start by explaining what Opportunity Fund does. So why don't you give us a little bit of a elevator spiel there?
Sure. So Opportunity Fund, we are the largest nonprofit microlender in the country. And our focus is to tackle the widening inequality by investing in underserved and overlooked small business owners and communities across the country, both urban and rural. Small businesses are a critical driver of new jobs. They employ 50% of the population and generate 64% of net new jobs. And entrepreneurship is a proven pathway to help move people into the middle class. Mm-hmm. But unfortunately, many deserving small business owners don't have access to the affordable and responsible credit that they need to support and grow their businesses. So we provide small loans, mostly to low to moderate income, ethnic minorities, women, and immigrants, to help them make that permanent and lasting change in their lives. So you can look at our model as a hand up, not a handout. Mm-hmm. We've seen firsthand the ripple effect of the loans that we make in the form of growing businesses, more jobs, more vibrant communities. And the organization has been in existence since 1994. And since that time, we've deployed more than $900 million and helped thousands of entrepreneurs invest in their futures. Right now, last year launched our new 5-year strategic plan where we are committed to deploy an additional $1.2 billion to small business owners across the country by 2023. And, our focus, as I said, we do about 75% of our borrowers are low to moderate income, 30% are women, and 85 to 90% are minority-owned businesses.
Right. Okay. And in addition to that, I also believe you are also a CDFI, right? So you get some of the benefits from that designation, I'm guessing. So maybe just a quick rundown for the listeners, just a short spiel on what a CDFI is.
Sure. So CDFIs are community-based, specialized financial institutions that serve low-income communities or people that live in distressed communities. And often they're working in market niches that may be underserved by traditional financial institutions. The CDFI is a designation that's provided by the U.S. Treasury Department for institutions that help low-income communities. So they are very strict in the measurement on who we serve. They open the pool of low-cost capital to us. And actually, on September 23rd of this year, marked the 25th anniversary of the CDFI Fund, which aims to expand economic opportunity by investing in organizations like Opportunity Fund to provide loans, technical assistance, and financial services.
Okay, so the other thing I want to talk about, because it's not, from my understanding when I was researching Opportunity Fund, it's not just about the loans. There's also, why don't you tell us about this new markets tax credit? What is that, and how does it fit in with what else you're doing?
Sure. It's very much complementary to what we do. So the CDFI Fund also administers the New Market Tax Credit Program, which builds and supports high-impact development projects like healthcare centers, homeless shelters, services for at-risk youth, food banks, and other much-needed services by low-income populations in neighborhoods. I look at that as a prime example of successful public and private partnering. So, CDFIs across the country leverage an additional $12 in private capital for every dollar of federal funding received through the New Markets Tax Credit Program. Mm-hmm. And so in our case, what we do is our program is designed to increase the flow of capital that's going to businesses and low-income communities, and it provides a modest tax incentive to private investors. Mm-hmm. Over the last 10 years, it really has proven that this program is a really effective, targeted, and cost-efficient financing tool for businesses, communities, and investors across the U.S. So we work with a variety of banks who act as the investors, and we're providing those tax credits to those investors. We've received, over $350 million worth of allocations from the CDFI Fund, and have allocated those to, right now, about $330 million of that has been put to work in these very high impact, as I said, homeless shelters, food banks, education services. I mean, you may have heard some of these in California, the Boys and Girls Clubhouse, Ravenswood Health Clinic, Compass Family Services. So these are the kind of projects that we are helping to finance.
Right. Okay, so I want to get back to the borrowers. I want to actually talk. And you gave us a little bit of just sort of a demographic of who the borrowers are, but I want to dig a little deeper there and maybe what kinds of companies are these small business owners borrowing money for? Just tell us a little bit about who they are.
Sure. So our clients really come from nearly every industry that you can imagine across the country, and they share a number of things in common. First, many of them are small mom and pops, anywhere between 1 to 3 employees and up to about half a dozen or so. Mm-hmm. We do have very few clients that have 100 employees, but that's really not the norm. It's more the smaller micro businesses. They're all incredibly hardworking and resilient. They're established and successful. They're looking to grow their businesses, so think about the dry cleaners expanding to a second location, or a woman who makes tamales, ready for a cargo van to start taking catering deliveries, or the restaurant in the corner from your house. These are borrowers. When they come to us, many of them, unfortunately, come to us looking to recover, because these days we see that many of these small businesses are trapped in debt cycles by not very good actors that are offering short-term, high-cost financing, with a direct take into their bank account. It's called merchant cash advance, mm-hmm. and so they're drowning in debt. These are very healthy businesses with great cash flow, but have a need for capital that's responsible and affordable. And unfortunately, they go online and they find these very easy to qualify for loans. They take them, and then they come to realize that they're doing more damage to their business than help. Our borrowers also, in many cases, don't have traditional documentation. Over 15 to 20% don't have credit or have thin files. Mm-hmm. So obviously, they're not a focus for many of the banks and lending institutions. Many of them have been, their average, to give you an idea, the median household income is about $38,000 of our borrowers. Okay. So these are really, individuals that are looking to set up their business and support themselves and their families, create jobs in their community, and then cause that ripple effect of, people that invest and save and invest in their communities.
Right. So then are these, you sort of said set up a business, which made me think, are these new businesses as well as established businesses?
So our requirement is that we look at borrowers that have in business at least 1 year.
Okay.
However, in some cases, if we have a borrower coming to us that has a lot of experience in the trade in which they're trying to set up. So they've been in the food industry, in the restaurant as a cook, and they come to us and say, look, we want to buy a mobile food truck to start our own. We will finance that mobile food truck. Mm-hmm. But it's because they've got experience in the trade and the business that they want to start.
Right. Got it. Okay. So what about the loans themselves? Let's just talk about the terms of these loans. What's the typical size, interest rate, the loan term? Tell us about the loans themselves.
Sure. So we loan anywhere between $2,600, that's $2,600, to $250,000, and obviously that's a big range. The average term is about 33 months. Our loans go anywhere from 12 months to 72 months, and our rates vary. And again, it depends on the size of the loan, the profile of the borrower, but our rates go anywhere between 7.5% to 18%.
Okay, so 18 is the high that they're going to pay?
Yeah.
Okay.
Yeah.
So then some of these, it sounds like some of them are really refinancing existing high interest debt. Like if they've got a merchant cash advance that's really crushing them, they might, you're finding that a few of them will just need to get out from under that. And so they're coming to you to try and refinance.
Yes. As a matter of fact, there is a paper that you can access on our website on affordable and unsustainable, which was a research that we did a few years back. When we spoke, we got about 100 clients that came to us to get refinancing, and we found that many of them, the average interest rate was 94% on the loans that they were borrowing for their business. Mm. Some of them we saw had rates up to 350%. And what we also learned was that most of these businesses were paying twice the amount in debt that they had available for their own cash flow. We were able to help about 50% of those borrowers, Peter. Unfortunately, the other 50% were so deep in the hole that we could not help them. But our focus is to get them into a responsible loan before they even have to go out and find a loan of that magnitude and that rate. And if they go there and find them before they find us, then trying to refinance them into a better loan that's going to help their business.
Right. And then, so I'm curious about the loan performance, because you've got, these are very reasonable rates. There's no question about it. These are for a small business to an underserved community. These rates are very reasonable. Is there any metrics you can share on how the loans have been performing?
Sure. So, we have a 95% repayment rate, which is one of those huge misconceptions that these borrowers are very high risk. If you applied the principles of responsible lending, which is underwriting every borrower for ability to pay, making sure that they have sufficient cash flow so that they can afford the loan, reporting credit to the credit bureaus, providing, reasonable pricing, what you're going to find is that you have not only very responsible borrowers that pay back 95% of the time, but also very loyal. Mm-hmm. And so that is one of our sort of biggest rewards, if you will, to see that these borrowers can take money, can do so much, invest and grow their business, and yet, we get a 95% repayment rate. The other piece is the survival rate of the businesses. Our businesses, after having taken and paid a loan after a few years, they show a 94% business survival rate. And that is twice that of the national average. So that's another statistic that we measure that we're very, very proud about.
Mm-hmm. So then what is it about your underwriting you think that is being able to have, obviously it's more than underwriting. It sounds like you've really got this sort of bond with your borrowers, but I want to just talk about the underwriting briefly. What kind of data do you use? How do you approach it? And what's your approval rate on these borrowers?
Yeah, so, it's a combination of things, right? The first thing is, we underwrite every single borrower for ability to pay. So that's at the top of the list. If you think about what are the first things you do, those are the first things we do. We believe that it doesn't make any sense to put a borrower in a loan that they cannot afford, particularly because we report credit to the Bureau. So that's number one. The number two is, we look beyond the numbers. We underwrite loans taking into consideration the borrower's experience, as I mentioned earlier, as well as the character. So, when we talk about collateral, for us, we look at collateral in terms of assets, but we look at moral collateral, which is very, very high within the community that we serve. As I mentioned, we report all loan payments to the credit bureaus because we believe that helping someone build or improve a credit score is helping borrowers build an asset. That is critical for any business or individual that's looking to grow and be able to do some of the very most basic financial transactions in this country, right? So renting a place, connecting utilities, getting a cell phone. So that's very important to us. The other thing that we do that I think is critical in the success of our lending is that we build in business advising and feedback throughout the underwriting process and the life of the loan. We believe that a little bit of the seed money, but the right kind of financial advice, those two combined are a real powerful combination to ensure the success of that loan and that borrower.
Right.
The other thing that we do, which is also very unique, is we, have a very empathetic collections program. So from time to time, we know that our borrowers get into trouble, in many cases for reasons that are beyond their control. And so rather than sending that loan to, collection immediately and charging against the customer, we take an approach to understand what the challenges they're having, how can we help them restructure the loan, extend the payment terms. And so what we find is that in 80% of the cases, those loans that go delinquent get back current, okay? And then finally, we make the process of paying us back as easy as possible. And I think that makes a huge difference. And then if you take that further down to dealing with immigrant populations, I think one of the most important things is making sure that you have cultural competence in our team. and that we understand the market. In other words, our people serving our people. When you build that trust with a borrower and they know that they're going to see Adela not just closing a loan, but they're going to see her in the school with her kids, in the soccer field, in the grocery store, there is a trust bond that's established between the lender and the borrower that really lasts for a very long time. And if they get in trouble, they're going to pick up the phone and call you.
Right. That makes sense. So then I know you can apply online to these loans, but you can also, I believe, apply in person. So what are most of your loans coming from the online channel or how are the borrowers getting in touch?
Yeah, so we have a combination of outreach and customer acquisition. So, we have boots on the ground for the very small of micro businesses, and we work with a significant network of community partners in California, about 50. These are other CDFIs that are providing either technical assistance, business advising, tax, legal, accounting services, but need somebody to provide the capital, and that's where we come in. So we get, a significant number of borrowers coming through our community partnership network. We also work with mobile food truck manufacturers. We work with trucking dealerships. We work with other banks that may decline customers for credit, and they send them to us. And then we have our online channel, and our online channel is mostly with a Lending Club partnership that I know you covered when we launched that expanded partnership back in April. And so that partnership is in 45 states now, California and 44 states outside of California. I'd say that our online channel generates about a third of the volume that we do, a third to 40% of the volume that we do. And then the other channels that I talked about generate the remaining.
Right. So just maybe to tell us about this relationship with Lending Club, because obviously I think most of the listeners would remember that Lending Club decided to stop originating loans themselves. They're sending them off to you guys and a funding circle. So maybe is this sort of, so that's where most of your online is coming from. And is this a partnership that you're hoping to deepen? I mean, what are your expectations for this partnership going forward?
Sure. So you covered this again, as I mentioned earlier, which was very exciting time for us. So Opportunity Fund established a partnership with Lending Club back in 2016. And at the time, it was thank you to a grant made by the JP Morgan Chase organization, where they wanted to see how a marketplace lender, the largest marketplace lender, could partner with a nonprofit to help borrowers that were declined by the online lender. So if a borrower came to Lending Club and they were declined for credit reasons, then we interfaced our systems with theirs through APIs, and they, in the background, would run that borrower against our own credit box. And then if we approved them, the borrower would get an immediate notification, congratulations, you have been approved, pre-qualified by one of our partners. And so we would take the borrower relationship from there, and we would underwrite the loan and, close the loan, service the loan, et cetera. We had that partnership in 13 states for a couple of years, a lot of success. We were able to help a lot of borrowers reduce their pricing from other options that they had if they had been turned down by Lending Club and by us. And so we felt that it was time to expand it. And so what we did is we said, look, we want to go nationwide with them, leverage your technology, integrate more, and then start to provide pre-qualified offers, not just to second-look customers throughout the country, but to what we're calling near-prime customers. Near-prime customers are customers that are not yet being approved by banks or other responsible lenders and are still going to, higher-cost online lenders. With that partnership and the expansion of that partnership back in April, we also recognize that, there's a lot of prime borrowers coming in through the Lending Club channel, but those are not necessarily Opportunity Fund's target market. Those are more the target market of organizations like Funding Circle. So Opportunity Fund is getting the second look in the near prime, and Funding Circle is getting all the prime-based customers. Right.
So then is this relationship unique? Are you looking to duplicate this with other potential online lenders, or how do you view it sort of as a channel that you can expand?
Sure. So, we obviously just launched this in April. We have met all of our goals in terms of loan originations, which has been wonderful. We believe that the combination of, our credit technology and their capabilities, our mission-based high-touch lending model, that we can continue to dramatically expand access to affordable capital to more underserved small business owners across the country. If you think about our partnership, we're taking care of about 80% of the market, that we believe 80% of the market of underserved small businesses. So we still have a lot of work to do with Lending Club to expand the partnership. We're in the final stages of building the more integrated technology solution. And so we're expecting to work on that for the next 6 to 12 months and then decide, where do we go from here? Is there opportunity for us to extend to other partnerships, which is a key element of our strategic plan that I mentioned earlier to deploy $1.2 billion. It is to partner with other organizations, both online, other CDFIs, other referral partnerships in order to extend our capabilities and be able to help more underserved populations across the country.
Yeah. So what about like an organization like Opportune, where you used to work, and obviously they're more focused on the consumer and personal loans, but is that the sort of company that you would consider partnering with?
Well, we're not a consumer lender. We are a small business lender, and while there's sort of when you get to the lower end of the pyramid, as I call it, there is a real blurry line between what's a consumer loan and what's a business loan, because a lot of consumers will borrow under their personal, credit, and they're investing, and they have other jobs, right, during the day, but they have a side business, whether they're in landscaping or restaurants, et cetera. So we don't have plans to become a consumer lender, at least for the foreseeable future. So our partnerships are going to be more focused with organizations that are acquiring true underserved small businesses.
Right. Okay, that makes sense. So then what about the capital that you're lending out? I mean, obviously you've got the CDFI fund that you talked about, where banks, I believe, can get CRA credit for the loans that they're putting out there. But maybe you could tell us what other sources of capital that you're working with.
Sure, absolutely. So the CDFI fund is crucial for us. And, I think we've gotten like $16.5 million worth of allocations since the fund has been in existence, which has been great. The bulk of our funding comes from traditional banks, financial institutions that are lending us through their Community Reinvestment Act. So, it's highly critical, highly impactful, because it's low-cost capital. And as you probably know, banks are required to invest capital in the communities in which they take deposits from and where they operate. And a lot of financial institutions don't necessarily have the expertise, the know-how, or the desire to lend to the kind of businesses that we lend to. So what they do in turn is they give us those loans, and we on-lend to those local communities. And so that has been incredible capital for us. Right now we have over $110 million worth of lines of credit. The bulk of that comes from CRA banks. We also have an impact investment note. 2 years ago, we issued the largest impact investment note that has ever been issued by a nonprofit small business lender, CDFI. We raised about $11.5 million from that. We're expanding that, and that had, investors, foundations, a lot of accredited individual investors. And so that provides another, important source of capital for us. And then we have a number of foundations that provide program-related investments. Banks provide EQ2s and other low-cost capital, which is obviously so critical for us because the rates you were talking about that are reasonable, the reason we can provide those kinds of rates is because we get very low cost of capital that helps support the lending at those rates.
Right. Yep, for sure. Okay, well, we're just about out of time, Luz. I just want to, maybe we could end with, talking about what's next for you guys. You've talked about your 5-year strategic plan, I know, but maybe give us a look, give us a bit of a window into next year, and what do you hope to achieve in 2020?
Yeah, so as I said, we're marching towards $1.2 billion deployed by 2023. Next year we're looking at deploying close to $140 million worth of capital. We are launching our Women of Opportunity initiative. As you can imagine, I am keenly focused in helping women-owned businesses achieve their true potential, and that's one segment of the population that unfortunately gets a minimum amount of debt capital when they ask for it. We're working with, obviously, Lending Club to expand that partnership and make it as productive as it can be. We also established a partnership with Key Bank to open in new markets with our trucking lending, starting in New York and hopefully expanding into other markets. We're looking to expand our impact investment fund to attract more institutional and individual accredited investors. We will continue. One of the key areas of our business is to advocate and help influence policy, both at the state, but national and regional level. And that's a big part, especially in these days where every time we turn around, we see that one of the programs that is benefiting these low-income communities is at risk of being eliminated. So our policy and advocacy work is going to take a very intense approach in 2020. I'm going to be spending time, talking at the CFPB next month about the need for us to collect data from small business owners under Section 1071 that they're evaluating. We're going to continue hiring, seeing our staff grow, hopefully by 200 people by the time we're done with this strategic plan. And just, relentlessly trying to manage risk, adopt new technology, which is key. Technology and data analytics are key for us to deliver the kind of growth and impact that we want to deliver. And just helping more borrowers, say more yeses to borrowers as we can, so that we can continue to close that, income inequality and support the communities in which we all work and serve.
Okay, well, it is a noble cause, and I think your organization. I think I hear about it. It's talked all the time about what great work you guys are doing. So I really appreciate you coming on the show today, Luz.
Peter, thank you so much for your time. As always, it's a pleasure.
Okay, see ya.
Talk to you soon. Bye-bye.
Bye. You can really tell talking with Luz right there that she's, that her company has developed a bond with their borrowers that is real. And obviously they have, they're serving an underserved population, and these people are very grateful for receiving this money. But it's more than that, because they develop this loyalty. I mean, this 95% repayment rate for what is essentially, let's face it, a near prime or subprime population. I mean, that to me is astounding, and not just in a consumer, but in a small business setting where these businesses are potentially, many businesses fail, as we know, and they've got a better success rate than average there as well. So they've worked out how to really attach themselves into the lives of these people, where they consider paying off their opportunity fund loan a very high priority. And I think that's the story here, that they've obviously done a great job in attracting these customers and underwriting them, but what they've done best at, as far as I can tell, is they have got loyalty I think that many other small business lenders would be quite envious of. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register.